So once we created our operating model and made our projections, now we're looking to build the free cash flows, to calculate the free cash flows, to determine the appropriate discount rate, and finally build a DCF model. So let's start with free cash flow modeling. We will be calculating unlevered free cash flows. Let's start with the first element, it's EBIT. Then we will have to adjust for effective tax rate. Here you go. Let's make it. Then go the adjustments for non-cash charges. And in our case, it's very simple. It's just depreciation and amortization. Finally, it's changes in operating assets and liabilities. And as we discussed, there are 6 main items. It's really critical to remember them for our DCF modeling course, since those are one of the main things that we're trying to figure out during the analysis of the operational items. So assets, it's accounts receivable line item, prepaid expenses, inventory. As for the liabilities, accounts payable, accrued expenses, and deferred revenue. So in all these cases, the units will be thousands of dollars. So copying it. So making it not bold. Here you are. So what we have here, and finally it's CapEx. So let's calculate. It's very easy since our operational model with all the projections is ready now. So let's just copy the EBIT from the model. Here you are, operating model EBIT. Then effective tax rate. So we can go to our assumptions, and here it is, 20% tax rate. Units here are obviously percentages. Adjustments for non-cash charges. Simply copying our depreciation and amortization from our schedule that we've made. Here you are, annual depreciation. Just copying it. So it's some of those. Changes in operating assets and liabilities. Accounts receivable. So here we need just to take the items from the cash flow statement. Accounts receivable, prepaid expenses, inventory, accounts payable, accrued expenses, and deferred revenue. Exactly what we need. So we can just link the first line item and copy everything here. Alright, and we need just the sum. So to make the sanity check, let's see what is the sum. It is minus 96. Let's go here, minus 96. Okay, perfect. As for the capex, exactly as we've done with depreciation, just going to schedule and copying it. So here you are. We just need to take EBIT multiplied by 1 minus the tax rate. Then we need to adjust for non-cash charges because we are saving on them. They help us to save us on taxes. Okay, adding back depreciation and amortization. This is the sole item here. Then factor in the change in operating assets and liabilities, and obviously there is capex. We need to subtract that because it's the cash spent. So we can copy this across, and here we are. Our unlevered free cash flows calculated. So next we will be calculating our weighted average cost of capital to properly discount those cash flows. Let's calculate the proper discount rate for our free cash flows. In the previous step we were calculating unlevered free cash flows, so we will have to calculate the WACC, the weighted average cost of capital, to discount those cash flows correctly. So let's start by making the assumptions for our discount rate calculations. So first we need the risk-free rate. As we are assuming that our company is operating in the United States, obviously the whole model is in dollars, so the risk-free rate here will be the Treasury bond yield, the most liquid Treasury bond yield, ideally long-term. So let's assume it's 271. And here we will make clear that it's Treasury long-term, Treasury bond yield. Alright, what's next? It's equity risk premium. It basically shows us by how much in general the equity as a class is looking to outperform the risk-free rate. We normally not guessing what it is, we're just taking it from the publication called Ibbotson or some other stuff. We can look it out in Bloomberg. So let's make it sure that we've taken it from Ibbotson. Let's assume it's 10. Then we have also to make sure that we are counting our debt, but since incorporating our debt, but since we assume that our company has no debt outstanding, since it's a startup, it's very difficult for it to attract, to get the funding in terms of debt financing. So we are assuming that the company has no debt, so we basically don't have to figure out what the interest on debt would be. So now we will have to figure out what would be the unlevered beta for all comparable companies. So you just look for the levered beta for these companies on Bloomberg or on Reuters or in other source you may be using. Then what you have to do is just to put here the equity value for the company and its tax rate. So then it's very simple. We will calculate the unlevered beta based on the formula. And here we will have to also incorporate our debt here. So levered beta, debt, equity value, tax rate, and unlevered beta. Brilliant. So here we are. So let's take, for instance, company A, company B, company C. What you do here is just you go to Bloomberg and you see the numbers. So it would be the levered beta. Once you picked up the beta, it always will be levered. So okay, so what now we have to do is just to see what the market value of debt that the company has. So for instance, for company 1 it can be 530, then it's again the same, and for this company it would be $3,500. Then equity value, here you go. Again, you're just looking for these numbers on Bloomberg or other source of financial information you're using. Let's assume the tax rate would be 20%. So it's relatively easy, and unlevered beta. So we will be calculating unlevered beta here. We're doing it based on the certain formula. So here we are taking our levered beta divided by 1 plus 1 minus tax rate multiplied by debt to equity ratio here, and just copying it. And what we need now is just to take the median of this set. Sometimes you will be taking average, but let's obviously take the median. So median is 0.51. Okay, so let's calculate the cost of equity. Obviously, our cost of equity is it is our risk-free rate plus equity risk premium multiplied by the beta of our comparable companies. So in practice, you can leave it as is, but the most sophisticated analysis will be to lever this beta based on the company capital structure that we are using, but for simplicity we'll take it as is. So its cost of equity equals 7.84, then weighted average cost of capital. So basically it's percentage of equity multiplied by the cost of equity, percentage of preferred stock multiplied by the cost of preferred stock, and percentage of debt multiplied by the cost of debt, and adjusted for the tax rate impact. So since we don't have debt here and we obviously don't have preferred stock here, our WACC will equal the cost of equity. So next, what we will have to do is to make the discount periods before calculating the present value of our unlevered free cash flows. So it's simply 1, 2, 3, 4, 5. Super. So we're ready to calculate our present value of unlevered free cash flows. Let's do that. We are taking the unlevered free cash flow, dividing it by 1 plus weighted average cost of capital, and adjusting for the discount period. Here we can take as well the mid-year discount and other adjustments like continuous discounting for the proper value allocation, but we will make it simple here. Yeah, here is my mistake. I haven't anchored the WACC here. So yeah, here we are. We've calculated the weighted average cost of capital and we're able to finally figure out what is the present value of unlevered free cash flows. Next, we will be calculating the terminal value in order to get our enterprise value for the whole company. Let's calculate our terminal value. To begin, we need to first determine the terminal value growth rate. Terminal growth rate. So units will be basically percentages, and we'll take something close, very close to long-term GDP growth or inflation. So it's, let's take 1.5 and comment close to long-term GDP growth, inflation. Super. Next, let's calculate the Gordon growth terminal multiple, terminal value. It will be in thousands of dollars. So to do that, it's very simple. We will have to take our final free cash flow. So we are taking our final free cash flow, multiplying it by 1 plus our terminal growth rate assumption, and dividing by weighted average cost of capital minus our terminal growth rate assumption. So here you go. Here's the terminal value. It's quite large relatively to our present value of unlevered free cash flows, and obviously versus a sum of unlevered free cash flows. But we here analyzing the startup, and let's leave it as is. In general, if the terminal value is more than 60% of your final result, you need to rebuild the model, you need to make another assumptions, you need to make the sanity checks, etc. So in this model, everything is all right, and because of aggressive assumptions for the company revenue growth, etc., you see here that our free cash flows more than tripled for over the course of 5 years. So that is why Gordon Growth's terminal value is so large. So it's fine, and obviously we will have to run sensitivities based on various growth rate assumptions, and of course to check whether it is roughly correct or not. To make the sanity check, we are calculating the implied terminal multiple. What it is, frankly speaking, you can calculate your terminal value based on your Gordon Growth method or based on the multiples method. So we calculate it based on the Gordon Growth method. So now we are trying to figure out what would be the terminal multiple implied by our result. So it's relatively simple. We just have to divide our Gordon Growth terminal value by company's EBITDA in the final year. So here you are. It's 11. Not bad. It's a tech startup. It's growing very fast, so it's quite good. So what we were doing here was just reverse engineering. So we were trying to figure out what is the equivalent implied terminal multiple. So okay, let's calculate the present value of terminal value. We'll measure it in thousands of dollars. We're just taking our terminal value and divide by 1 plus our weighted average cost of capital and adjusting for the discount period. here it is. So next we will calculate the enterprise value and then move to the equity value of the company. Let's calculate the enterprise value and then we'll be able to figure out what the implied equity value is. So enterprise value. Measuring in thousands. Very easy. So what we have to do is just to take the sum of the present value of unlevered free cash flows that we've calculated and add the Gordon Growth terminal value that we were able to determine. One small note here, as we already discussed, the terminal value in our model represents the large percentage of the enterprise value. In corporate finance, we usually are trying to keep the terminal value not more than 60% of the total enterprise value. But here it's just a startup. We are not able to project any further than 5 years because the uncertainty, because of the unreliability of our assumptions. So let's leave it as is. So here are, we need just to take the discounted terminal value. Yeah, it's now correct. So to get to the equity value, we need to make some adjustments. So let's make them. First, it's debt, it's preferred stock, it's non-controlling interest, it's capital leases, line item, unfunded pension obligations, and restructuring, environmental liabilities. And of course, we need to add cash, deferred tax assets, equity investments, and long-term investments. Everything in thousands. Here you go. So let's calculate the sums. So it's simple. In our model, we simplified almost everything. So we don't have the debt, we don't have the preferred stock, no non-controlling interest, capital leases, unfunded pension obligations, etc. So the only thing we have here is just cash. So let's make this adjustment. Let's link this item to our cash balance on the cash flow statement, and here you are. We are able finally to calculate our implied equity value. It would be in thousands. So what we have to do is to take the enterprise value, subtract the adjustments, and add. So what's going on? So we subtract this one and add this. So here you go. So here we get the implied equity value. Obviously, it doesn't tell us a lot, since we will have to create the sensitivities to see how equity value and enterprise value change on the various assumptions on terminal multiple, on terminal growth rate, and on various operational assumptions that we've made here. But the model itself is now ready. So we've calculated both the historical operating model, we've calculated the projected operating model, we've done the income statement, balance sheet, and cash flow statement, linked them together, calculated the free cash flows, discounted them using the weighted average cost of capital here, and finally, here we are. Here is our estimate of the implied equity value.